Everywhere you turn, you hear only one thing. Invest in index funds, invest in index funds, invest in index funds. Low cost, performed perfectly over the last 900 million years. Invest in index funds. Stocks have averaged 10% per year. Stocks have averaged 9% per year. Low cost index funds. That's all I hear. What I want to share with you today is, first, my idea that's complete bullshit and it's very misleading to tell people that investing in index funds is good, because it will be good, yes, over the very long term, but those who want to just buy and forget can simply invest in better vehicles for perhaps same or even lower risk. Today what I want to share with you is the comparison of the S&P 500, the risks, expected returns, values, and Berkshire Hathaway, Warren Buffett's company. Both are diversified. We'll compare the fundamentals, we'll compare the growth, and we will compare what you can expect from the future. And I'll show you that one is much better than the other. Let's start with risk. So they say that if you want low risk, you have to be well diversified. If we look at the S&P 500, 22% of the index fund is in information technology. Risky or not? 15% in financials, 15% in healthcare, 12% consumer discretionary, 10% industrials, 9% staples, 5% energy, only 3% in utilities, which is a very defensive sector because we will always use energy. So very skewed towards information technology and financials, two sectors that do very bad in a recession. Let's compare it to what Berkshire Hathaway has. So 26% of earnings comes from railroads, 41% from lollipops to jet airplanes, very well diversified businesses, 17% from defensive utilities, and 16% of earnings comes from insurance. So diversification, I think you agree with me, is equal, if not even better, with Berkshire because of its lower exposure to information technology. Yes, they did buy Apple, but still just a small percentage of the company. Let's compare financial metrics. S&P 500 price earnings ratio, the third row, is 25.28, thus implying a long-term return at stable earnings of 4%. Berkshire Hathaway, the price earnings ratio is 18.57, implying a long-term return of 5.38%, thus already 1.3 percentage points higher than the S&P 500. Cyclically adjusted price earnings ratio that takes 10-year average earnings is a bit lower for Berkshire and relatively historically high for the S&P 500. Price to book value extremely high for the S&P 500, 3.15, and 1.43 for Berkshire. Remember that Buffett does buybacks at a price to book value of 1.2. So if Berkshire's stock falls to 1.2 book value, you can expect Buffett buying the company. So the downside is limited. Who's gonna buy the S&P 500 if there is a crisis? I don't know. Another metric, very important, book value growth over the last 10 years. S&P 500, 3.8%, dividend is 1.92, so if you add the dividend to the book value growth, we are somewhere close to 5.7%. Berkshire Hathaway, much higher, 7.6% growth in book value. So the fundamentals are clearly on Berkshire's side. Let's see how those fundamentals evolve over the past 10 years, and probably will do the same in the future, and I'll show you later why. Earnings over the last 10 years, S&P 500 earnings grew 45%, Berkshire's grew 71%. Revenue growth over the last 10 years, S&P 500 revenue grew only 12%. Only 12%, that's below inflation. Berkshire Hathaway revenue grew 89%. Book value growth, S&P 500 book value grew 45%, Berkshire's grew 109%. So how is that possible? Two companies, one, let's say an index fund, the other also an index fund, both overweight the US economy. How is it possible that one grows fundamentals, grows earnings, while the other is, let's say, stagnating or showing slow below inflation growth? How is that possible? What's the difference? Where does the money go? I'll show you. The main difference between Berkshire and S&P 500 is their orientation towards growth and value creating. This is reflected in buybacks and dividends. As I said, Berkshire does buybacks only at 120% of book value, thus does not destroy shareholder value. On the other hand, all the other companies in the S&P 500, they do buybacks as much as they can do. They do buybacks on steroids. And they especially love to do buybacks when the stock prices are extremely high. Look at this chart here. You can see that in 2007 buybacks were 600 billion per year and currently are again close to 600 billion. 2009, 2010 there was a yearly low when buybacks were close to only 100 billion. Of course, when stocks are expensive, you do more buybacks. And when stocks are cheap, God forbid you buy your own stocks back. But Buffett was doing it, so very interesting situation. But then again, let's tell people to buy index funds. Let's check the buybacks to net income. If we look the buybacks to net income from the trailing 12 months, we can see that they are 70-60% of net income is spent on buyback. Okay, you can say, still there is 30% left for growth. Yes, but buybacks don't include dividends. If I include dividends, then more than 120% of net earnings is spent. So if you spend more than you earn, you're destroying value. Especially if you buy back your own stocks at extremely high price to book values. Remember, price to book value of the S&P 500 was above 3. So people are paying, let's say, $1 for the stock price for 30 cents of actual value. Again, let's buy index funds. Come on, buy index funds. Okay, you think buybacks, they lower earnings, but we have seen that earnings didn't grow per share, book value goes through the roof. So what are they doing with those buybacks? They are pushing the stock prices up. That's why the S&P 500 has a higher valuation than Berkshire Hathaway. If buybacks stop, you will immediately see the S&P 500 drop to a low level valuation. Now these buybacks could even be good if they lower the number of shares outstanding for the S&P 500. However, since 2010 till now, so 7 years of extreme buybacks, the aggregate number of common shares outstanding for the S&P 500 fell only 4%. So just 4%, and that is the buyback yield in 1 year. In 7 years, the buybacks lowered the number of shares outstanding by 4%. Should be, with their yield, it should be 7 years, 30%. Doesn't happen. Why? Because management likes to push the stock prices up so that they can reward themselves with more options, exercise more options and give themselves more stocks. And again, let's buy more index funds. Great. So to conclude, I strongly believe that we should not recommend index funds to people, but Berkshire Hathaway. The diversification is the same. The price-earnings ratio is high. The revenue growth is much higher, better than inflation. Earnings growth is much higher. Book value growth is much higher. The management is very good. Does not issue shares like all the other companies do. Does not do buybacks that destroy shareholder value. and is well diversified. What do you want more? So please, if you have somebody or you are a person that wants to buy, invest, buy and forget for the next 30 years, for your retirement, for your children's tuition, please look at Berkshire and look at index funds. Then compare and then I'm sure you can make a rational decision. Thank you very much for watching, and I'm sure I'll see you in the next video. Please leave your comments below, click like, subscribe for more content, and have a great day and very profitable investments.